Hi, I'm Harper Jones with Life with Leverage, and we coach people on the infinite banking concept and how you can become your own banker. Today, we're going to talk about how you can use a whole life insurance contract if you fund properly and plan properly. Later in life, it can be a fantastic tax free passive income vehicle to either supplement some income for retirement or to just give you some additional income later on in life. So let's look at an example. Now, if we flip to the screen here, we're going to see a life insurance contract that I ran for a gentleman named Ronald Reagan. It is with a insurance carrier that we work with called Ameritas Life. And this is one of their whole life policies that they offer. And the name of this policy is Ameritas Access Whole Life. I actually was on the design team when they were building out this policy, and they kept infinite banking concept in mind while they were designing it, which is awesome. And with the policy, you're going to have very strong guarantees versus the dividend. You're going to have a great dividend, but you're going to have very strong guarantees overall. And that's fantastic for someone who wants earlier access to their cash value. Now, how we design this policy, you would have to check out the video I did called Infinite Banking Policy Design for the breakdown. But I'm going to walk through the highlights of the policy on what we're putting in for how many years, and then what we're able to borrow and live off of later on in life. Now, as you can see, this gentleman is a male, age 38, and we're putting in $100,000 per year for 4 years. And then year 5 and on, we're going to fund $40,000 until age 70. Then from age 71 to age 90, we're going to withdraw or borrow against the policy, shall I say, which means it's tax-free, and be able to live off that and not pay any interest. So we'll walk through it. So let me zoom in, and you're going to see that in year 1, here's our contract premium and riders that I'm highlighting and $100,000. We're going to look at the non-guaranteed right side. The only difference between the guaranteed and the non-guaranteed is that it's suggesting Ameritas will issue a dividend and will have that dividend reinvested back in the policy, which they cannot guarantee, but they have done since they've been in existence since year 1887. So it'd be fair to say that that's going to happen, but let's look at the right side of the ledger. So you put in $100,000, and year 2 put in 100, year 3, year 4, right? And then you're going to put in $40,000 each year thereafter until age 70. Okay. Now, with that said, this is us funding a life insurance contract all those years, but we're able to borrow against this cash value the whole entire time to finance other investments, to finance our tax bills, to be our own banker for anything in our life that we plan and want to use it for, which is part of the infinite banking concept. So this is just an additional benefit that really isn't referenced that often. Now let's jump down to age 70. So when we get down to age 70, we see that we have contributed $1.52 million into this contract, okay? And our cash value is $3.245 million, and which is, more than double, all tax-free growth. And our death benefit's $5.285 million. Now, if you read Nelson Nash's book, Becoming Your Own Banker, when you get to the equipment financing examples towards the end of the book, what he is displaying is when you use your policies and you bank with the policies, you're going to actually get better results than is depicted and shown right here, because you're utilizing your bank or your life insurance contract to put additional interest or additional paid up addition riders into your policy and grow it more. If you have not read his book, I highly suggest you read the book and go through it all. Now, as you get to age 71 through 90, we now no longer need to put any premiums into the policy, and we're able to now borrow. You could withdraw, but what we're doing is we're borrowing from the policy, taking a policy loan or a line of credit against the cash value in the amount of $200,000 a year. And any interest that is going to be due from borrowing 200,000, we're letting just add to the loan and compound, because the policy itself is now in such a snowball effect and has such a tailwind that it's going to be offsetting the interest and some of the amount you're borrowing over time, and we'll see. And anyone who's very technical and detailed, this policy got at a reduced paid up, or RPU, at age 71, which means we're just ceasing paying premiums for a few years, because this policy specifically, we are paying premiums till age 75, but I'm going to cease paying them at age 71 for simplicity for this video. But that's for people that are super technical. And you know who you are, you'd be smirking right now. So 200,000 a year, and we're doing that till age 90. So what happens is we have contributed 1.52 million into this life insurance contract. Over all the years, we're able to borrow against our cash value as it's growing and compounding tax-free within there, and we can leverage against that to build more wealth elsewhere, which is not depicted or shown here on this document. Now, over those 20 years, we would draw 200,000 times 20, $4 million. Now, what other vehicle can you put 1.5 million into and then be able to, I keep using the term withdraw, but in this video, we are merely borrowing against the policy, not withdrawing. We are borrowing $4 million tax-free, which is really almost like $5, $6, $7 million, depending on what your potential tax bracket may be. So you put in 1.52 million, you're able to pocket $4 million tax-free over those 20 years, and you still, if you were to pass away at age 90, pass on 1.4, almost $1.5 million in death benefit proceeds to the next generation or a charity or wherever you want it to go. So what other product or vehicle are you able to do this in such a tax-free manner that's so beneficial to you, right? And remember, we're pocketing that $4 million without having to service or pay any interest out of our own pocket, right? It'll get paid down the road by the existing death benefit, and then our net death benefit still is 1.5-ish million, as you can see here in this corner. So to recap, 1.52 we put in, 4 million we were able to live off of tax-free, and then our total death benefit net after all that is still 1.5. If you were to borrow less, these numbers would be higher. That would pass on to the next generation. And you essentially have an open line of credit against your policy of a couple million. Well, in reality, you're probably going to have other assets or inheritance or cash or investments that now you could place in your ideal savings vehicle or your policy, because you have room for that windfall amount. Now, if you want to elaborate on this and have more questions, you can book a call with me and go on my website at lifewithleverage.com. You could email me at harper@lifewithleverage.com. Love to hear from you, and we can make any type of policy that you think is going to work for you. Obviously, we have designs and parameters we stick within, but what I mean is you don't have to do the set 100,000. A lot of people do. Some people do way more. Some people do less, and that's totally fine to meet you where you're at and what your goals and objectives are. So looking forward to hearing from you, and I hope this video helped.